Eve.
And joining us now, Jeremy Nelson, partner with Element Wealth. Jeremy, good to see you, man.
Good to be here.
Thought we'd have you in, and so you must be good luck because the Dow's been flipped around in the last hour from being in the red to in the green. I don't exactly know why. I don't think they know, right?
No, I mean, sure, we got a deal last night. I've been one that said I don't really think the market's trading too much around this debt ceiling deal because I think it was a foregone conclusion that something was going to get done.
Right. I think so.
Yep.
I mean, and what's aggravated me about the whole thing is the fear-mongering. And I talked about this some yesterday on the program. So the fact that we can't borrow more money, it doesn't mean we don't have any money, that we don't have any cash. We got $400 billion a month coming into the Treasury.
$4.8 trillion a year coming in. I mean, it's not like they're totally broke.
So you got expenses of $520, $530. Yeah. Figure it out, guys. And but the common refrain always is, we're going to default on our debt. Right, which would be catastrophic. If we didn't make Treasury payments, that's a problem.
Absolutely. Well, remember back, 2011, we went through this.
We did.
And, there was we kind of were at that point where there wasn't a deal and the parks were shut down and, so non-essential services were shut down and the market sold off and then it came back pretty quickly. Right?
Yeah. But we did get downgraded for what that's worth. Remember, we went from AAA to
AA minus, but Moody's kept us at AAA.
Okay.
Yeah, there's one of the three that kept us at AAA.
Okay.
Yeah.
Well, and for what that's worth. I mean, versus what? The rest of the dang world, which is like triple Z?
Yeah. Yeah. Exactly. I mean, and a lot of people have been coming in my office and they're like, or getting phone calls. Hey, what do you think about this debt ceiling thing? Do we need to go run and hide? This is going to be catastrophic. I'm like,
yeah.
We've kind of been through this a whole bunch of times since 2011, and it's kind of a nothing burger. The issue is that we have $31.5 trillion of debt,
right,
and interest rates are much higher than they were a few years ago. And so now what the issue becomes that the interest on the debt as a percentage of the budget is going to be increasing rapidly over the next few years, right? That's the issue. The issue is that we have $31.5 trillion of debt and we're running $2 trillion deficits.
Right. That's the issue. And that, of course, it drives monetary policy, which affects your credit cards, your mortgage rates, et cetera.
Yeah.
And so that's a big old problem. And it drives inflation as well.
Exactly. I mean, it's
deficits more than anything drive
absolutely.
inflation.
There's too much spending happening at the federal government, right? And the one thing that we know is that the more money that stays in people's pockets, or the less we're taking away from businesses, they're going to spend that money more efficiently than the government is redistributing the money. Right. And so there's a better multiplier to it. The government's just very inefficient in how it handles money. So, look, I think that the Republicans are right to be pushing and trying to cut spending. The only thing that I ask of them as well is, let's do this when you're in power as well. Like, this has got to be a concerted effort that we are finally at this point. Our federal debt is 118.5% of GDP. It used to be like 100% of GDP, debt to GDP ratio was like this trigger. And that's what took Greece down. And we're sitting here at 118.5% right now. We have to act, and I look forward to and hope that in the 2024 election cycle that the debt becomes a primary topic because, in Obama's last year, our deficit was pushing down to less than $600 billion.
That's right.
And here we are at $2 trillion now, and we're way past COVID. Right. Like, that's done.
Right.
So it's time to get this budget under control.
Right. So a question on the C Spire text line: do other countries operate with a debt? Yeah, most do. Honestly,
do. Yeah.
But what's I think more meaningful is not so much the amount, the dollar value or the currency value of their debt, but their debt to GDP.
That's what matters. It's not about how much debt you have. It's about your ability to service it, right? If someone's worth $10 million and they've got $1 million of debt, well, that's not a big deal compared to someone that has $1 million and $1 million of debt.
That's right.
So it's that ratio that matters.
Yeah, and I can tell you, you well know, when you go fishing for money from investors, that's what they look at. Leverage is what it's called. And it's just, okay, well, you want this much, but you're making that much. We got to keep that into some constraints of parameters of ratios typically. Yeah. And usually it's that leverage is calculated as EBITDA to debt is typically what they look at. And different industries, they have different parameters around that they use for investment guidance. But, for example, I looked it up. Spain has 113% debt to GDP. We actually had 111 or so in World War II. We just recently passed that figure now, which was the record held in this country for the highest debt to GDP.
Yeah, and I mean
World War II, but we were financing a war.
That made a lot more sense back then, and this is something that I've been harping about for a long time and saying, look, here's the writing on the wall. We're going to get to this breaking point, and back in 2018 at our economic forecast, I did a whole presentation and I laid out like, hey, we think sometime in the early 2020s. There's going to be a big problem here. Yeah. We're going to have to deal with this because if interest rates normalize, here's what we're going to look at. Well, we threw COVID on top of that, right? Now, a lot of that debt is sitting on, this is a little technical, but a lot of the debt, about $9.5 trillion of it or so is sitting on the Fed's balance sheet.
That's right.
So that interest is actually being paid back to ourselves because they send the money to the Treasury. Yeah. But it's still an astronomical number that needs to be addressed.
And it's important to make that point because I've said it on the program before, and I think people can sort of scratch their heads, and it's understandable. We actually owe ourselves. Yes. At the end of the day, all this debt's owed to ourselves.
Yes, but if you can't continue to do that forever because then the foreign markets lose confidence in you, your status as the reserve currency, all these things come into play at that point in time. So
our saving grace is they're worse off than we are.
Well, hey, I mean, Spain's less than us now, but that was the whole thing about back in 2014 with the European debt crisis, right? That was a huge issue and forced austerity. They've actually been doing stuff about it, right? And we haven't. And we're to a point now where Spain's debt to GDP ratio is lower than ours.
Yeah, which is crazy. England, I think, has always had carried a bunch of debt as well. They're slightly over 100% to GDP. But from an investment perspective, you touched on that a bit. What are you hearing inside your contacts in the investment community with respect to concerns, first of all, about the debt, and then just fiscal policy and our fiscal financial situation? Yeah. Altogether.
I go back to a conference call I was on with Ben Bernanke, former chairman of the Federal Reserve, a couple of years ago. And, in a polite way, I mean, obviously he's not going to rip on the government too much. But, this was not a public call. He basically said, look, it is time, right? Fiscal or monetary policy has bailed out bad fiscal policy for a long time.
That's right.
And we're to the point where we've seen we saw the breaking point with the inflation in 2022, right? That monetary policy can only take you so far. And eventually, if you're printing money, it's going to become inflationary. And so, wham, here we are. And we are being, slapped in the face right now and realizing, okay, Washington has to come up with a better fiscal plan.
But so this is what frustrates me, though, Jeremy. You get all these guys that know their constituents want to hear the condemnation of out-of-control government spending. Okay, I agree. But if you pin them down and say, okay, what are we going to cut? We don't get too far. Nope. Can we talk about that on the other side of the break? We got Jeremy Nelson, partner at Element Wealth, in the Element Wealth studio. Stay with us. Crazy. All right, so we got Jeremy Nelson, partner at Element Wealth, and we're talking about the debt ceiling and how that affects the investment community, but let's also just talk in general about what the outlook is now. We know the government spends too much money. Mm-hmm. Well, we know that because they produce deficits. I mean, it's not like an opinion. Well, you spend too much money. Well, no, you're producing $2 trillion deficits. So the president has regularly boasted about how he cut the deficit from his first year to his second year. We're presently in his third year. Mm-hmm. He did, but that's simply a matter of a function of not also passing a $1.9 trillion COVID bill, right? Which we were just handing money out like it was popcorn back in those days. So, you didn't repeat that in year two, and I guess you could take credit for that. You cut the deficit. But we're on a trajectory. You've seen the Treasury reports on this. We're looking at $2 trillion this year without extraordinary COVID spending. $2 trillion. And the left says, well, that's because of the Trump tax cuts. No, we're producing more revenue than ever in this country. You've seen the reports on that.
The fundamental issue is that we have not decided what the role of the government is.
Totally agree.
Right? And then we, there's this bartering back and forth all the time, flip-flopping in power. Nobody really we haven't determined as a nation what the role of the government is. And we kind of continue to fund things that are not the responsibilities of the government.
Yep.
Right. And the more that the government continues to do that, the more they're going to continue to run these unsustainable deficits. And, I was telling you at the break, right? I grew up in Canada, and I grew up in a debt crisis where we were forced to do something. They passed the GST, which was the goods and services tax, because and all that money had to go to the debt to get the country under control. And for many years, the country was in a better position. Now they've gone nuts with Trudeau, and we won't even get into all that stuff.
No interest in that. Yeah.
But, we're getting pushed in this direction where we are going to be forced to do something here. And when you are forced to do something, it is a lot harder and a lot uglier than when, you do it on your own.
No doubt about it.
So we need Washington to come together, right, in order to really come up with a plan. And Republicans have to push hard on this through, the rest of the Biden administration and through whatever the next administration is, that it's time for fiscal responsibility. Because if we don't, right, that debt, that $31.5 trillion that we're talking about, that doesn't include the unfunded liabilities.
$79 trillion. I just looked it up a couple of days ago.
So you've got these unfunded liabilities that are sitting out there as well that we all know, right? There's less money going into Social Security than is going out, and that trend is going to continue here for some years. You got to come up with a plan here.
They won't touch it. It's off the table. We're not touching that. We've agreed that before we start even talking about how we're going to get through this debt ceiling expiring, our ability to borrow expiring. Both parties said we won't touch that. Because it's politically unpopular, as you know. Yeah. And even if what they came up with to reform those programs was reasonable in that it didn't touch anybody currently receiving benefits, and maybe it doesn't touch anybody that's within, say, 10 or 20 years of receiving benefits, that would still get so distorted by each side that opposed any sort of reform and the media that the average person would just think, oh my gosh, my check's going down next week. Mm-hmm. That's what would happen.
Yeah, and that's where it gets so political. But I'm not an advocate. I don't believe that people that are receiving Social Security, I don't call it an entitlement because you've paid a lot into that program, right?
Well, that's actually why they call it an entitlement. Is the way they describe it. You're entitled to it.
Yeah,
that's what they say.
You've paid a lot of money in. Your employers over the years have paid a lot of money in.
Yep.
Right. So I don't look at it as an entitlement.
Okay.
But you've got to make these things actuarially sound. But also, you got to go find other places in the budget that you're going to cut. I mean, we've all had budgeting issues at home or in our businesses, and you go, hey, look, how can I cut 5% or 10%, right? You can't tell me that you can't go across these different agencies and say, pull out the red marker, find the fat, get rid of it.
They won't do it, and I don't understand it. You could apply the same concept here in Mississippi every time the subject of the gas tax comes up. We just had the state director of the American Legion Boys State talking about them deliberating some chosen issues, and one of those was the gas tax, which is very controversial here in Mississippi. I think you'd find people to get a lot more on board with the concept if you would at least commission just a study and analysis, a deep dive into the money that's spent on roads and bridges in the state. And I'm not suggesting that it's inefficient. I don't really know at this point, because I don't know that a third party has gone in and done such an analysis, and maybe take that as a kind of support for that. But we don't do that in the federal government. I've never heard anybody say, well, let's take a fine-tooth comb to Medicaid, $600 billion a year, and make sure that it's running as absolutely efficiently as possible, and that there's no duplicitous and superfluous and unnecessary expenses. Nobody does that.
Yep.
That ought to be on the table as part of a debt ceiling deal.
That's what you've got to do. I mean, it's time for the grown-ups in the room to get in there and figure this out and make the hard decisions. Like, we can get there. We absolutely can. There's just got to be the political will. And, where I see the bigger impact for retirees, right? Like, let's talk about what our listeners really want to hear about, which is, if we don't do something, then in the coming years, we're going to be forced to start to do things, and it's going to get uglier, and that's going to have even bigger impacts on markets down the road. So, again, like right now, I'm not losing sleep about this debt ceiling debate because we've been here before, right? When people said, hey, we need to panic and sell, I'm like, no, don't sell based on this, because even if we went down like we did in 2011 when it was all happening, if you sold, you missed out because it recovered back by the end of the year. I don't see this as a permanent impairment to markets, right? And obviously today we're seeing a deal, and the market's not exploding to the upside. Yeah. It's up a little bit. Yeah. And what that's we're still in this tight trading range that we've been in. What it's telling you is the market didn't really care about this because they knew something was going to get done.
Yeah, it's more focused on other issues. Maybe the jobs report this morning was more meaningful to the markets than this news is. Honestly.
But if the government were to actually cut some spending and get itself under control, because it's got plenty of money coming in, if they cut the spending and get everything under control, the country's not going to go away, right? The country is going to be better off long term.
Yeah, and we don't seem to really want to talk about the difficult issues, the big ones. And we've also got the investment community. It seems like it's all about watching the Fed. Mm-hmm. We watch the Fed more than we do earnings. Is that your take? Does he see that?
Well, because we had the Fed put, right? We got addicted to the Fed post-financial crisis, right? And now
That's true.
It's like, look, it's time to worry about companies actually making money.
Fundamentals. Yep. We got to go back to fundamentals and technicals and get out of this I'm sitting here waiting for what the Fed does, and they hang on every word every time Powell talks. And you watch the market trying to figure it out and parse all this language and all these words. Yep. But to a great extent, it goes back to poor fiscal policy, and the Fed has to get in and is trying to fight that with monetary policy. Yep. Gosh, we got to do something. All right, let's go tell them, Jeremy.
We'll do our best.
Appreciate you coming in. Right. Thanks a lot.
Thanks, Gerard.
Yep. Jeremy Nelson, partner at Element Wealth, has been our guest.